This is the Power Options suite of tools right now. We're looking at the basic structure of a 14-day free trial. Okay, we discussed this a couple of weeks ago, Isaac. It doesn't mean I'm not going to answer it now, but there is an archived webinar showing up, but I'll try to do it again. Isaac wants to know, can you please discuss a calendar collar strategy? Okay, well, it's a form of a collar, but this one's a little reversed. Okay, so I buy the stock, buy a front month at the money put, and sell a FAR call for a credit. Okay, this is actually what I refer to as sort of a reverse collar, not a reversal, which is shorting the stock, selling a put, and buying a call where they're putting the call at the same strike price. You get a straight line profit and loss chart. This to me is it's sort of a reverse collar. In most collars, you want the put to be further out in time or equal to the short call strike price. Okay, but let's take a look at the profit and loss chart of a potential position in this structure. And we're going to go ahead and just go to the custom spread tool on Power Options. I'll tell you that this type of collar is not supported in the search tool at Power Options. We typically just look for standard collars where the expiration date is the same or where the put option is further out in time than the call. The structure of this type of calendar collar, as Isaac calls it, what I usually call a reverse collar, is a little bit different. I'm going to use Mondelez as an example. Now, this is a recent trade I opened as a married put, as a RadioActive trade about a week ago. So I'm just going to grab this and see if we can construct a collar as Isaac describes it and see what the pros and cons are. Before I do that, though, let's go ahead and take a look at a collar. If I was going to open what we'd consider a standard collar today, I would buy 100 shares of MDLZ, and I might go out 14 days or to standard April expiration. Let's just go out 14 days out in time to April 7th. And what I would look to do in this case, with the stock currently trading, at 43.82, I'd probably sell the at-the-money call, the 44 strike, and we're going to call that 50 cents at midpoint. And at the same time, I'm going to take some of that premium away, and I'm going to buy an out-of-the-money 42 strike put. Now, Isaac, I know this isn't what you're asking, but we're just doing this as a review for those who might not be familiar with the collar. Okay, so I'm going to put this selling the call in at 50 cents, and we're going to buy the 42 put for 20 cents. So I'm taking away some of my premium. I'll still get a 30-cent positive premium and the potential to get assigned at 44 and protection in place at 42. Okay, now this position is a standard collar. This is the profit and loss chart you'd look for. The numbers I tend to look for on my collars, my standard collars, are a little bit different. What I typically look for is a potential profit if I'm assigned. Just like a covered call, if the stock moves above 44, I'm usually looking for a return of around 2% or so if I'm 14 days out, maybe 1.5% to 2% if I'm 14 days out, or 2.5% to 3% assigned if I'm 28 to 30 days out in time, in that range, 20 to 40 days out, further out. And the risk threshold I usually look for is if I'm looking for a 2% gain, it's about this. I want a 3 to 4% risk, looking for a 2% gain. But if I go a month out, I want this to be about 4.5% to 5%. Now, some investors will do this differently. In order to pay the lower cost going forward, lower cost per day, they might buy a further out in time put as well. Okay, and I'm just going through some of the questions here to make sure that, there we go, okay. So I might buy this put further out in time. So if I bought the 42 put 6 months out in time, it might cost me $1. Not 6 times the cost of buying 14 days out, 14 days out, and 14 days out. So I'm paying less per day, but a higher upfront cost. Okay, and that sort of gives us a calendar spread profit and loss chart. Let's take a look very quickly. So rather than buying the 1 month out, let's go to July. And the 42 strike put here is at 163. So 14, we're going 10 times the amount out in time, but I'm only paying 16 times the, or 1.6 times the cost, not 10 times the cost. Okay. Now this might not give me the best risk-reward profile on this position, but I still make a return of around 1.1%. I'm risking a higher amount, but this sort of mimics a calendar spread, a diagonal calendar spread as far as the profit and loss chart goes. But what Isaac wants to do, and what's taught by some other investors out there, is we want to reverse the idea. I'm not saying I do, but they want to reverse the idea. We're going to take a look at that. But first, let's talk about one of the mainstays of options trading. Whenever you look to trade options, if you're looking at credit spreads, standard covered calls, cash secured naked puts, you see that most commonly everyone will say that you want to trade the option somewhere between 7 to 30 days out in time. When you're selling premium, you want to sell weekly or monthly to get the highest annualized return. Okay, because if I'm able to sell month by month by month by month, I'm going to get a greater premium far term. Okay, so higher annualized return. When I'm buying options, as we just showed, the option that's 10 times the amount out in time is not going to be 10 times the cost. It's going to be more expensive, but you pay less per day buying further out in time. So if I bought the option week by week and month by month, I'd have a higher annualized cost. So when I'm buying, even for just speculating on movement on the stock over a 20 or 30-day period, I want to buy farther out in time, maybe 60 to 150 days out or more, depending on my strategy, so I have a lower annualized cost. So that's why most people talk about selling covered calls on a weekly or monthly basis. Why not sell the 6-month out call? Because you're lowering your annual return. You're getting a higher premium up front, but you're lowering your annualized return. Why would I want to buy an option that's 4 months out in time if I'm planning an event 2 weeks ahead? It's because if that event doesn't happen, if you bought a 7-day out option and it didn't happen, then you bought another 7-day out option and the movement didn't happen, then you bought another 7-day out, you're increasing your annualized cost. But if you bought it 60 to 75 to 90 days out to begin with, you're lowering your annual cost in the position. All right? So, that being said, this idea of this reverse collar is, instead of selling the call near term and buying the put equal or further out, we want to take a look at buying and at the money. So we're going to buy that 44 put, Isaac, and we're going to call it 90 cents for our 44 put. Okay, 14 days out, 90 cents premium for the at the money. This is another rule we kind of want to talk about as well. Now I need 90 cents, and I want to sell a call out of the money. So let's go to May. And the 45 calls at 106, good, but the 46 at 74. That's 56 days out versus 14. Let's try it. Not a lot of wiggle room here with the out of the money call. Let's go out to June. Let's see what we can get in June if we can go to 46. Oh, absolutely. Okay. So I'll go to the 46 call here. We're going to sell that for, let's call it 110. All right. So what are we doing? I'm selling essentially a 85-day out, roughly close to pretty much a 3-month out call that's 2 points out of the money, roughly 5% out of the money for a credit of 110, and I'm buying a near-term at the money April 44 put for 90 cents. I get a positive credit of 20 cents to reduce the cost basis. But what are we looking at? Here is the profit and loss chart of this position. And this is based on April expiration only. Okay, the near-term expiration. When you have two different options here that you're evaluating, the profit and loss chart is based on what the graph would look like at the near term. Okay, now it shows here that it kind of looks like the maximum profit is unlimited. It really isn't. You're still capped at 46. When the stock starts to go above 50, even at April expiration, that delta is getting closer to 1. So you do probably have a capped gain, probably at around 180 or 190 to the upside. Okay, the risk is only $64, so it's a low-risk position. That's the sort of reverse collars. And you've almost created something like a synthetic calendar straddle or strangle where you have that V profit and loss chart. So is this a good idea around earnings or when you're expecting a move? Yes. Why? Well, look at it this way. At April, the break even is at 41.50 to the downside. Now, sure, you have a low risk, but in order to start getting into the profit in one direction or the other, you're going to need the stock to fall below 41.50. on the other side to make a profit on the upside, and this is at April expiration now. I need the stock to be above 45.06. So although I have a really low risk, at the worst case scenario to April, if the stock's trading right at 44, is only 1.5%, the potential for profit, the expected profit, is lowered because I need a wider move in one direction or the other as opposed to a standard collar, or as opposed to even that calendar collar that we looked at originally. Now, what happens in the first 14 days? If Mondelez does not move in my desired direction, because I didn't do this around an earnings play, and in the first 14 days, Mondelez is still right around 43.80 or 44.20. Let's say it's at 44.20, all right? My call expires worthless, or I myself have to think reverse when I'm talking about a reverse collar. Our put expires worthless in this case. All right, so the stock's at 44.20, the put expires worthless. Now, am I going to be able to buy back this call because we've gone 14 days at a time? Not very well. See, the time value of this call, because I sold the call further out, the time value decay on this call is not going to be very high. It might have only dropped to $1 or 95 cents, meaning I only realized 10 cents of the time premium for those 14 days. Okay, maybe 15 cents, maybe 20. But I haven't realized the time decay that I would usually get in a covered call in the first month or in a standard collar in my favor. It's going to retain most of that time value. We're not going to see a time decay, a rapid time decay, assuming everything stayed the same, until we get in the last 25 to 20 days of this transaction, of the short call, which is 85 days out. So you say, okay, I want to duplicate this. I gave up my 90 cents because this put expired worthless. The stock moved up 40 cents to 44.20. Now you buy another 14-day out, the 21st, the standard April 44 put, for another 90 cents. Now what's happened? Your risk increases, your cost base increases, and this is no longer a positive premium. Okay? So you need the movement to happen in order for this to work out right. Yes, it gives you a low risk, but your expectancy of profit is lowered drastically. You need a much bigger move in the shorter term in order to realize a profit on this trade. And you know, I've seen some of the investors and some of the gurus who teach this strategy say that, oh, well, that's okay. If the stock doesn't do what you want, you can easily liquidate, let the put expire, and then you can buy to close your call cheaply. Well, that's only if the stock falls. Okay, this call is only going to get cheap if the stock drops down to 43, 42, or 41. If it's June, 85 days out, we'd lower it to 70. Even though it's out of the money at 46, it's still going to retain 2.5 to 3 months of time premium. It's going to be much harder to buy that back and realize this decay in your favor. So what does this strategy offer? What are the pluses, the benefits of this strategy? It's very low risk. Okay, it was lower risk even than that standard collar. It's about a 3.5% risk I showed on the standard collar. So it's very low risk. Okay, what are the other benefits? Well, it can profit in both directions in the short term, right? So that's positive. It can profit in both directions. Of course, you need it to move in one direction or the other in order to profit. Another positive is the risk-reward ratio looks really good. Okay, risk to reward is very positive. And what do I mean by that? The most you could lose in the worst case scenario if the stock's trading right at 44 is $64 in the short term to April expiration. Why is that important? Well, it's because it's one pinpoint, meaning that it is very unlikely that Mondelez is going to be trading right at 44 in the next 14 days. It might be at 43.50. It might be at 44.50. It might go to 41.50. It might go to 45. Okay, so it's going to move from this point one direction or the other. The worst case scenario is a loss of $64 or 1.5% for 14 days. That's a positive. The max reward, if the stock really gaps up to, let's say 50, let's say 55, well, the 46 might cost you $9 to close, but it's getting close to intrinsic value. So you could pay $9 to close this, your put expires, and then sell the stock for 55. Okay, so you're still getting 44 back. So you're still getting a reasonable profit on the position. maybe not a lot, but you're still making a reasonable profit. But you see here that max profit, if it really takes off, is close to 180. So that's a 3-to-1 reward to risk ratio. And that's very positive. What are the negatives? Okay, we already discussed them. Need a wider movement one direction or the other to realize a profit on that first in the first cycle. And if you don't get the movement you want in the first cycle, you have to buy another put, which is going to increase the cost basis. So now your risk might be close to 150, which would also lower your profits going out to the May series or the April standard series. So you need a wider move to profit. Number two, although we're looking at the differences of this, one of the other cons, the negatives of this position is it goes against two core concepts of trading. Number one is that when we're selling, we want to sell near term to maximize annualized return. And we want to buy farther out. This is the reverse. We're selling far to get a lower annualized premium, and we're buying near, sell far, buy near. Okay. There we go. Sorry about that. We're selling far out and buying near term. So this increases our annual cost and lowers our annualized premiums. And the second concept of that is what's called the at-the-money bell curve. And what the at-the-money bell curve shows us is that options at any expiration on a given stock, the options that are at the money have the highest time value. And options that are in the money or out of the money have the lowest time value. Here I'm buying an at-the-money option, which has the highest time value right now of all options in that 7th of April series. So I'm buying at the money, which is opposite of what we typically want to do, and I'm selling out of the money for the lowest time premium. So this 46 has a much lower time premium than the at-the-money June 44. Okay? And typically, as we can see here, although there are ways to manage this position, another negative is this call premium will not decay in your favor until you really get into the last 20 days, which is 65 days away from here. So in 14 days, if the stock doesn't move what you want, you're not going to realize a lot of this positive premium. This could expire, and if you decide to liquidate, you could still pay $1 to close this. You only took 10 cents in and paid 90 cents. Now you sell your stock at $44.20, but guess what? By paying that $1 back in, your investment went up to $44.62, so now you're at a 40-cent loss. Is it a limited loss? Yes. It's a very low loss at this point, okay? But the expectancy of profit's lowered because you need that wider movement again to realize a profit to one side or the other. No, this was done at a credit, Sam, because we sold a June call at 110 and bought the April near-term 44 put at 90. A standard collar is done at a credit. I'm sorry, standard collar is done at a credit as well. This is looking at doing this as a credit with buying the stock, buying the at-the-money put, and selling the far-out call for a higher premium. That will receive a credit, but it is a total debit transaction. I think I see what you mean. I'm confusing two things, Sam. The options transaction is a credit. Since I'm buying the stock, the position as a whole is a debit. And if I went to liquidate it, I'd be paying a debit as well because I'd be paying $1 again to close the call. And I wouldn't get anything back for the put, if the stock's at $44.20. But I'd still potentially lose because my cost basis would go up to $44.62 from where it is now. All right? So those are my thoughts on this reverse collar. It's not something I use in my personal account. If I think that there's going to be a movement coming up in the near term because of an earnings event or something along those lines, I'm likely buying a straddle or a strangle to get that profit and loss chart and only put this 7 or 14 days out if I know an event's coming up that's going to cause a swing wildly one direction or the other. If you do have a stock, Isaac, that you're long-term bullish on and you have earnings coming up in 2 weeks, or let's say 3 weeks, okay, well, maybe you've already got the out-of-the-money covered call in the position out to May or out to June or July. So then the plan for the earnings in case the stock falls, you might want to buy an at-the-money or slightly out-of-the-money put So in the near term, you see this kind of position, but you know that at the end, you're just protecting it because if the stock falls, the put will hedge the loss you take on the stock, and you still got that call sitting out there as well. Okay, so it's a position that does offer low risk, which I'm a fan of. You can profit in both ways, which I am also a fan of, but at the same time, it gives you a slightly lower expectancy of profit because you typically need a larger move. And at the same time, it goes against the standard theories of options that I want to be selling near term and buying further out in time. And I want to be selling at the money instead of buying at the money, and selling out or in the money instead of selling, selling out of the money. I want to be buying out of the money and in the money instead of selling it. I want to be selling at the money instead of buying it. Okay. All right, Joel followed up to our series we were doing on calendar spreads, said, Mike, when are you going to do the calendar diagonal spread management webinar? I don't know. I was hoping to do it this week, but something came up. I am not going to be available next week at all. There will not be any webinars next week, Joel. So hopefully the following week, we'll see what we can come up with. But keep an eye out for some other information that will come out to you related to calendar spreads in the series that we went on earlier as well. Okay, so David, next question coming in. At expiration, do they use end of day closing price or the end of the after hours closing price on the stock? David, it depends on the expiration. Neither is really used at the end of day closing price. I hate to say that, but I think that's relatively true. Most weekly options will actually have a settlement, I think, of around 5 or 5:15 Eastern time on Friday. Okay, so the weekly options, the ones you may have traded today, or the ones you may have traded, for next week, I think the settlement time is at 5:15. Well, I think that's when the after-hours closing is usually done. But at the same time, I apologize. I've heard it also said that the settlement actually occurs around 7:30 p.m. Eastern time on Friday for the weeklies. Standard expiration, David, as we experienced last week, the actual settlement doesn't go through until Saturday. Even though 4 o'clock or really 3:59 p.m. on Friday is the last time you can trade it, a standard expiration, the settlement time is still on Saturday, so the price that's used would likely be any after-hours trading that happened at that time. Okay, so if you had a covered call through expiration and let's say it's Mondelez and we'd sold a 44 call and it ended at 43.80, but Mondelez released earnings after market today and the after hours price pushed it up to 46, I know I'd probably be assigned on Monday. Even though at first I thought it was going to expire worthless because I'm 20 cents under, I left the call open. But then the earnings came out at 4:05 p.m. Eastern, and by 4:30 the stock was up at 46 because of positive earnings. I'm assuming that's going to be called away from me on Monday. Okay? All right. Even though it closed at 43.80, the after hours pushed it up. Okay. Suhas says, please explain how to handle an option in a stock when it does a reverse split. If you have a call option and you bought a strike price, say, of $3, okay, a strike of 3, and the stock does a 10-for-1 split, how does it price the new strike price? Will it still be 3? No. Okay, so on a standard 2-to-1 split, what we would see, of course, let's just go to a portfolio tool here. Okay. Good. These are all credit spreads we entered from one of our other webinars. Okay, so let's just take a look at ACIA. I sold an April 50 put and bought a 45 put, and the net credit was around 720 for 8 contracts. Okay. Now, if we had a standard 2-to-1 split, of course, the stock would decline in price, meaning that it would drop down to $28 per share, and I'd have the 25 put and the 22.5 put. And at the time the split occurs, my monetary value going in would be the same going out. And what I mean by that is if right now I see I can liquidate this particular position for a gain of 620, if they do a 2-to-1 split, I now have 16 contracts of the 25 strike and 16 of the 22.5, and my liquidation value would still be the same. I'd still have a profit of $100 on the position, because it would still only cost me $620 to get out of those positions, because these prices would drop to maybe 54 cents and 15 cents at 16 contracts. Okay. On the reverse, the opposite would happen. All right, so if you had a $3 strike and there's a 10-to-1 split, so the stock went from 4 to 40, I'd assume that you would now have a 30 strike option. But it gets tricky. Here's the problem. In a standard 2-to-1 split, if you know the stock did a split from 50 to 25, or in this case 56 to 28, okay, well, the monetary value has to be the same. So I'd now have 200 shares of stock at 25 when I had 100, or I'd have 16 contracts there. Now, a reverse split, if it went 10-to-1 and you had a $3 strike, that means it went up to 30. This gets very strange very quickly. And the reason why I say that is because the option may no longer represent 100 shares of stock. It may only represent 10. They might actually try to force you out of the option and force you to rebuy in at a different strike price after the reverse split. That happened to me on SH, by the way. I was in a married put on SH playing the downside of the market. And what happened is they did some kind of weird split. It was really a distribution, but they treated it as a reverse split. And so suddenly, in my portfolio, I now had, instead of having 100 shares of SH, the reverse SPY, at $19 per share, I now had 50 shares of stock at $38 per share. My put, which was the 20 strike put on the married put, I did not now have a 40 strike put on the position. When they did the reversal, they didn't also move me to a 40 strike put, because really they can't. Here's how they treated it. It's very strange, and I didn't know this until this happened to me. So let's kind of map this out again. Let's go back to the custom spread tool, and I think it's better if we kind of look at the numbers here. Here's what happened in my situation. It was a distribution, but they treated it as a reverse split. And let's see. See, it's already at, yeah, see, it's still up at 34.75, so this isn't going to make a lot of sense, but let me add a 20 put in here at 102. I'm sorry, 1.82. Okay. All right, so here was essentially the married put I had. Now, when that reversal happened, this 100 shares of stock went to 50 shares of SH at $38 per share. What I couldn't figure out is when I went to my broker, I'm still holding a 20 strike put. Shouldn't make any sense. Okay? I thought I should be moved up to a 40 strike put, but they didn't, because they can't. Because this can't be half of a put. It can't be half of a contract. So if I had had 200 shares maybe, and then I had 100 shares at 38, they might have converted to one at 40. But I had 100 shares and one put. They can't convert this to half a put. So I was still holding a 20 strike put. The idea was that if the stock fell to 20 or below again, it dropped back down to 19, which was, would be unheard of. But if it fell back down to 19, I have a $9.50 loss on 50 shares, and I have a 20 strike put, which represents 100 shares. So that should still be countering it. It was very, very bizarre. So with yours, if you have a $3 strike and you have a 10-to-1 reversal, I'd assume that you would be up now at a 30 strike option, which would have the same monetary premium. However, it depends on the strategy that you're in or that it's linked to. If it's a covered call, it's going to be really strange looking. Okay, they might do some weird adjustments on that as well, so it'll be interesting to see on that. Okay, All right. All right. Let me see here. Sorry, folks. Give me 1 second here. I'm scrolling through. I'm looking at some of the comments that came in on this discussion. I think Sam said, is the same, I had a debit spread on Netflix at 145, 148. The stock closed at 141. Oh, this is, I'm sorry. I'm going to go back here. This comment, follow-up comment by Sam was related to the expiration in the money after hours. Sam says he had a debit spread with a strike of 148, 145, and the stock closed at 141. You did buy a put at 148, which gives you a little leverage, but the position is at a loss today. Okay. All right. So that was in relation to what we talked about before. Okay, I don't know if I made this clear, Suhas, but what I was saying is that if you had, he said, so my question is, you bought 10 contracts at the $3 strike price, then after the reverse split, will you have 10 contracts at 3? Or just one contract at 3? I think you'll have one contract at 30. Okay? Because say the stock was at 4 and you were holding the option, the 3 strike, you have the reverse 10-to-1 split and it goes up to 40. So now I think you'd have one contract at 30 is what would happen with a reverse split. But ask your broker how they're handling, because a lot of times they may actually close out those options too for the monetary value. So the gain that you would have had pre-split is equal to what they paid you, and they may redistribute options later on at the higher strike prices, especially if there is any other kind of alternative requirement. That's rare that happens, but it can also happen where in these reverse splits they will actually close out the options and then reissue a whole new chain later on. I've only seen that happen once. Usually I think what's going to happen is your 10 contracts at the 3 strike are going to become one contract at 30. But the same monetary value you had on the position here before the split will be equal to the same monetary value you have after the split to start. And then what the stock does afterwards is what the stock does afterwards. Okay. All right, so let's go back up. I'm sorry, I wanted to scroll through those there. Okay, Shangareth asked a question, is there a way to view transactions by weeklies rather than monthly? I think he was talking about in the portfolio. And so if I'm looking in my portfolio and I go into the transactions field, I can look yearly here, quarterly, or monthly, but I don't have a view here in the transactions or in the analysis to look at it by weekly, okay, or all expirations. You can look at all expirations here, or the next 9 days. Inside the portfolio itself, if you're tracking your open positions, we can look for options that have expirations in the next 9 days. But in the transactions menu, we don't have a weekly available right now. It's just done by the month of expiration. Okay, all right. Let's see, let me scroll down here. I just want to check a few things. Okay, Simon, good. Okay, Simon, I got about 5 questions here already. It's perfectly fine. I just wanted to scroll down and make sure no one had commented on the topics. I have to scroll down the questions, see if there's commentary on what we just discussed. All right. Scott says, MU stock popped today. I held a 25 put, now worthless for the most part. How wise would it have been to buy a put, an April 30 or July 30 put, income method number 12? It would have been bad, Scott. Okay. What is Scott talking about? Scott is talking about sort of a radioactive trading position. And I'm sorry, Scott, I didn't cheat, but I've been trying a fun new strategy recently, and I'll explain it in a little bit, but I've had some really good luck with it in the past 4 cycles that I've done it. But let's go here. You had it at 24. All right, there we go. Let me pause the screen for a second. I'm going to open another window here. There we go. Okay, so MU. Okay, so what Scott's saying is that he had a married put position. And you had a 24 put. I'm going to say that was maybe out to April or July, somewhere. And you mentioned a July put. Maybe your original put was July. The 24 should still have some value in it, pretty decent value, 85 cents. That's still good. But let's say you had the May put. 24 is about 28 cents, okay? So let's say you bought the position. You bought MU and it was around 22.50, for example, several months ago, and you bought the May 24 put at that time for around 385. I know these numbers aren't exact, Scott, but just follow me with this for a second, okay? Okay, oh, the original was April, okay. So if I do that, correct? There we go. Okay, so we'll use May for now, Scott, but I'll just use an example. So, yesterday, the earnings came out, or the end of close. Let's go back 2 days. Sorry, let me go back to the chain. Let me go back 2 days now. Today was the pop at 196. It was as high as 29.80 at the market open. But let's go back a couple days. I'll go to Monday. Okay, I'll go to March 20th. And at that point, let's say that we were worried about a negative earnings on the position. So I went to an April 21. The stock's at 26.21. So to do the income method number 12, I might have bought a 26 put for 110, or you might have gone in the money at 27 at 160. But let's take the sake of the argument. Let's do the 26 at 112. Okay, the April 26 at 112. So today we're going to buy, or a few days ago we would have bought the April 26 put at 112. Now, at the time, it would have looked like a reasonable trade. You're still making a profit on the position. In this case, you probably have a higher profit on just MU if it's just a standard married put without a call sold against it. But if the stock had stagnated and hadn't moved and stayed right at 26, well, we know now what had happened. We increased the cost basis. If I went to sell to close the put now, that April put, because the stock gapped up, we would only get back 29 or 30 cents. So let's be nice to ourselves and say we got 30 cents back. So what would this essentially be? It would essentially be like you sold a call for 30 and had to buy it back for 112. Only you bought a put trying to protect extra downside in case there was a large gap, and you lost 82 cents. So it would have increased the cost basis and increased the risk. But because of the movement, you're still at a profit. So if you're uncertain about an earnings coming up on a stock, I'd say that yes, it's a good idea, okay, in that case. However, what would the effect have been? If the stock gaps up, you lose the extra money you paid for the put, but because this was a good 7-8% gain, the jump in the stock more than countered that extra 80 cents or 90 cents you would have lost buying the April put. And if the stock had fallen 25% or 7% or 8%, you would have had a profit on the downside instead of a loss of 4.5% or 5%, or whatever the loss was at that time. Okay? A tale of two cities, ladies and gentlemen. Let me go back in time here again. Actually, no, let me just do this. Tale of two cities. What am I talking about? I'm going to go to big charts very quickly. In my own personal account at Fusion, RadioActive Trading, so far this year, a couple of positions may have frustrated customers. And what am I talking about? Right here on eBay, earnings. Let me go back to a 6-month chart. I was in this position as a radioactive trade with about a maximum 5.6% potential loss if the stock fell. I think I had the stock at 29.15, and I had the 30 strike put. Okay, so my 30 put is here. I bought the stock at 29.15. So stock, and here's my put strike. Right, so I kind of had a married put that looks something like this with a maximum risk, of course, of about 5.5%. I got in December in this area here. Okay, so it moved up and pulled back, and then it moved up here, and I was thinking about rolling the 30 put, and I didn't. Then it sort of came back, and then it dropped. Okay, I know it's hard to see, but that's what it did. I was not sure what was going on with this stock. It seemed like it had been strong, and then it looked like it was going weak going into earnings. There was even a little MACD crossover to the downside. So instead of having just the married put position going into earnings, I bought a May 29 strike put for about $1.19, which gave me the synthetic Strangle. And what happened? Well, we see it. The stock gapped up from earnings from about 30 to about 33, and it closed at around 32, and then it just went up there, and then kept going. Okay, so when I sold to close my put for a loss right after the earnings, I took my risk, the total cost based on the position, from 5.5 up to about 8%. Okay, now the stock has continued up well, so I've rolled the put up twice. I'm holding the 34 put now. I had a 34 call expire recently, and then again here, and I haven't sold a new 34 call yet because I haven't really decided what the stock's going to do, but looking at this, Monday and Tuesday are going to determine if I sell the 34 or look for maybe an income method number 5. Okay, so what am I babbling about? This happened in January, and I was upset with myself because if I hadn't done income method number 12, hindsight's 20/20, I would have had a larger profit to the upside. Of course, if it had fallen, I would have had a profit. So a few weeks later, I'm in a position, Ubiquity Networks, where I got into the stock at about $59 per share, somewhere over here, okay, and I had a 65 strike put up here. So it was a married put again with about a risk of 6%. Heading into the earnings, the stock had moved up to 64.90. Everything looked good about this going into the earnings. I liked the MACD, the Bollinger Band range. It was looking strong. I'd sold calls against it and lowered my risk on the position. And I had a small risk at the time, and I figured, hey, I don't want to take the chance of buying income method number 12 because if it gaps up to 70, where I would have a 15 or 16% gain on the position, I'd be at a gain of only 2 or 3% because of the extra put. Of course, what happens? This is the one that drops 20%. At one point, it was down as low as $48 per share. Had I done 12 here, I would have exited this position with a gain of 14.8%, not at the first mark of earnings when the stock opened the next day at 53, but the next day when it closed at 49.50. So it would have been a gain of 14.8%. Instead, I was pretty much locked in at that point to a loss of about 5.8%. Okay. So income method number 12, creating the synthetic straddle by adding an extra put around earnings, is a very protective thing to do, and it's a very safe thing to do, but it does come with its caveats. On eBay, I ended up giving up more money because I thought it was going to go bearish, and because I was gun shy, I didn't do it on Ubiquity Networks, which would have resulted in a very high profit. Okay. Okay, so Isaac had a follow-up here, and the position. Oh, sorry, before Isaac, let me get there. Valan asks, how soon does the put option strike price reflect the coming X-dividend amount, and is it based on the current delta? I think the dividend is typically priced in, the dividend for the Ex-dividend date is typically priced into a put option about 4 to 5 weeks before expiration is what I've typically seen. It can vary, though. It varies by stock. All right, but in general, a month to a month and 2 weeks out in time before the Ex-dividend date is typically when I already see that put, I'm sorry, the dividend priced into the put premium. Yeah, the delta does kind of reflect that price because it's reflected on without the dividend taken into account, well, the dividend is still taken into account in the Black-Scholes pricing models. But yeah, the delta kind of takes that into effect as well. Or I should say that that's taken into effect in the delta calculation as well, the dividend payment on a regular stock. Okay. All right, so that being said, let me go back up now to Isaac's follow-up comment. Remember, Isaac had asked about that reverse collar kind of thing we were talking about at the beginning. What Isaac says, I had a short naked put position on DKS, okay? So, let's say that when the stock was at around 50 or 49.50 per share, we sold the 47 put for 70 cents for April. Okay, now of course the stock's fallen below 47, not much. But again, now we're slightly in the money. So maybe we did the 48, for example. Okay. But he says this became deep out of the money after earnings. Short naked put position. Wait, did DKS pop? I thought it fell. I think you mean deep in the money. Yeah, maybe this here was the earnings. So yeah, it's about 52. The earnings came out. So maybe you had a 50 strike. Let's use the 50 strike put. I think you meant deep in the money, Isaac. Okay. So let me change this to the 50. April. And let's say again when it was at 52, we got 75 cents. Yes, I'll remember to change it to sell this time. Thank you. Okay, there we go. All right, so here's my cash secured naked put. When the stock was at 52, we sold a 50 strike put for 75 cents. Now the stock's trading below it. Isaac says this became deep in the money, I think. Stop kept going down even after rolling to the next month. Okay, so it broke 50. Maybe you rolled from the March 50 to the April 48, and now it's down to 47. It says I could not defend it and closed it for a loss. Is there anything I could have done? Okay, well, the stock is continuing to fall. So now I see where you're coming from in that strategy. What is one of the things I could have done? Okay, well, let's look at this. First series. You said you would roll down and it kept moving down, but let's take my first series. Let's say, for example, everyone, no, it's hard to visualize, but it's already passed. Let's say this was our March 50 put. And a couple days before expiration, the earnings came out, and now the stock was down to $48 before it continued down to where it is at 47 or $49 even before it continued to move down. Okay. What are some of the things that we could have done? Well, you did the first one. You bought back the put and rolled it down to a lower strike price, but then the stop kept coming down. Okay, that's a problem with management on naked puts or credit spreads. If you say, oh, my bull put was threatened and the stock fell, let me just move my strikes down. Well, that only works if the stock recovers. If it keeps falling, then you're going to lose more, right? You didn't get any advantage by rolling it down. Okay, because you had to pay more to close this. You probably received a lower premium than you did originally anyway, so now you're almost at a debit and it keeps falling. Or you have to roll out 3 months in time to get a credit to make it look profitable. Okay, so you're right. Your plan was likely that the stock was going to recover. That's what you're hoping for, but it hasn't yet. I'm not saying it won't recover. I'm not saying it won't continue to go down, but you still have time for it to recover, although you're still looking in the money. Now, you did close it. Okay, so what were the other opportunities? Well, another opportunity is, of course, if you think it's going to recover, is to take assignment. You now would have owned X amount of shares of stock with a cost basis of $49.25. And then you could sell a 50 call against it. Or I could have converted it into a collar. Okay, so let me take assignment. And let's say we bought 100 shares at $49.25. And when I took the assignment, maybe I sold the April 50 call at that time, for let's call it 70 cents. And then we would have bought maybe the 46 put with a stock at around 49. Let's say that would have cost us 60 cents. So I still get a small credit. Now this isn't going to look good. Oh no, it still does look good. It's still a profit, but now keep in mind you have a maximum risk of 6.4%. But again, didn't address the downside. You could have converted it into a bull put credit spread. Once you rolled your short put down, if you bought this lower strike put, you'd have a similar risk reward profile, but without the margin cost. Would have been a leveraged trade. You could have also, once you rolled down, as we saw to that lower April strike put, you might have been able to try to do a ratio, but you wouldn't have liked the profit and loss chart. So let's say after everything was said and done, you rolled down to the April 49 put, and your total credit was 25 cents, including the buyback from the original put that was at a loss, and then the new premium you collected, but you still had a positive credit of 25 cents. And at that time, maybe you could have bought the 46, but now this is assuming the stock's right around 49.20 or so, below the 50 strike before it fell further. And now maybe I buy 2 of these, probably for a price of, what did I say, 60 cents, maybe 55. Okay, so this would be a debit. Yeah, but now you can't realize a profit to the upside. So this one you would have done betting that the stock continues to go down, not if it goes up. Okay, all right, so Isaac, I'm not going to spend a lot of time more on this because I still have about 5 questions to go through. But I don't want to ignore any questions what's coming in. But here's what I want you to do. Okay, later on this weekend, Isaac, I want you to go to powerup.com/webinars.asp. Okay, and where that'll take you is right here to our free webinars page. 2 webinars I want you to take a look at this weekend if you have the time and for your strategies. I hope you do for your strategies going forward. Under the Options Strategies tab, I have a full webinar on, that I can't find. There's a full webinar here on managing your naked put positions. So this talks about the approach that Ernie and myself use to adjust a naked put to help maximize the gains on the winners or minimize the losses. Whether the naked performed as you wanted, dropped just below your strike price, or dropped significantly, we show a few ways to consider turning a loser into a winner or maximize a profit. There's different ways. And another one of those ways is talked about here. Under the options concepts section, there's one called manage your broken position. We talk about alternative methods for managing a stock position that has fallen in price, a covered call that has moved against you, which is similar, managing a sold put that is in the money or the stock has been put to you, and conversations on managing bullish spread positions. So there's two webinars there, one on managing naked puts where we discuss our approach based on your sentiment going forward, whether you think it's still going to be bearish after it's fallen or you think it's going to recover. And then here, if you end up getting put the stock or even talking about naked put, there's another webinar here on managing your broken position. So if you have the time, I want you to check those two out as well to see what you can find. Okay. All right. Okay, you had the 52.5 put. Okay, so there still might be some ideas there for that as well. Okay. All right. So Sunash, a follow-up question. I know there's one or two other questions there. So you're right. I'm sorry. I didn't mention that because we weren't talking about it. So going back to Sunas, I'm sorry, I keep saying Sunash. Suhas, I'm sorry, Suhas. Okay. 10 contracts at the $3 strike with a price of $1. Okay, that's what his position has. So now this should go to a 30 strike call with a 10 to 1, it would probably go down to 10 cents. You'd now have one 30 strike call at 10 cents of value, but the monetary amount for selling to close that call would be exactly the same pre-split and post-split. Okay. Sam says, I took profit at MU before the earnings. I was unlucky on MU and missed the 250 move. Okay, I had been doing a couple of things this week. What I've been doing, and I'm not going to recommend this yet, I don't even want to tell anyone about this yet because I haven't perfected it. I've been lucky with 5 out of 5 wins so far on positions. What I did is I ran a search in the long straddle for options that expired in less than 5 days and had earnings coming up in the next 2 days. So I did a weekly option strangle on Adobe, which had a jump, Nike, which had a jump to the downside, MU, which had a jump up, and I forget the other position. I'm sorry, the 5th position is coming up on Monday. I apologize. The 5th position is coming up on Monday. And so I'm paying about anywhere from $1.60 to $2.20 for the call and the put in the 1 week out straddle. And so far, I've been able to close most of them at about $2.80 or $2.90. On MU, let's go back. I can't remember when I opened the position. MU chain, I want to say it was Monday. Knowing that the earnings were coming out on Thursday, MU, that looks right. MU is at 26.21. I bought the 26 call for, actually it was about 86 cents, and I think I paid 80 cents. No, it was 96 cents and 85 cents here, so I had a value of 170. And then, of course, when the market opened up today, it actually opened at about 29.80. I was only able to get 345 because as soon as I saw it at 29.80, I put my order in. The minute I put my order in, it was only up to 29.40, and then it was 29.35. So it was falling from where it was at the very open at 29.80, and I was playing catch-up. But again, I got into the position for about $1.80 for both contracts. I sold the call for 345, of course, and the put expired worthless. This is the 26 strike at 340 earlier today, 345. So that's what I've been playing with on those, and it's really risky because you need at least an 7 to 8% movement in order to be successful. And I saw the 7.5% movement down on Nike, the 7% movement up on Adobe, and of course this morning it was almost a 10%, a little bit above a 10% movement on MU, but then it gave back a lot to it as well. But that's good. Yeah, it was hard to catch the high price this morning at 29.80. It might have actually hit 30 right before the open. or right at the open. But when I first looked at it, it was at 29.80, and then it just started to fall from there and ended up at 28.43 as we see here. All right. Okay, Simeon says, I hope this isn't too off topic, but was reading about various option strategies and came across a covered short. When would it be appropriate to use this strategy, and what should I most be concerned about? A covered short. I wonder if you just mean a married call, which is the opposite of the married put we looked at earlier. Okay, so when we go to custom spread tool, you know, I showed that Mondelez position, MDLZ, and I had bought stock at 44.66. It would help if I put it in the right column, huh? And I bought a January 47 strike put at 540. Yep, that's exactly right. My maximum risk on this position is 306. I have 300 plus days of coverage on my long stock position. It is bullish. And you'd say, you know, actually, let me pause that for a moment. When you look at this situation here, you say, okay, well, you've invested $5,006 on a stock trading at 44.66. You're not going to realize a dime until the stock goes up to $50.16. Well, I just recently wrote a blog on that. So if you go to blog.radioactivetrading.com, okay, you know, why buy a married put? You start off underwater, and we talk about how that in this position I'm in, that yes, I did pay 540 for the put. I'm only risking 306 on the position, but I don't need the stock to go up 316 to realize a profit. In fact, if the stock goes up about, you know, to $45 per share from when I got in, which was 34 cents, in the first, you know, 5 or 10 days from when I opened the position, I'm going to be at a profit because the put doesn't go to zero. Okay, I just wanted to show that. So if you go to blog.radioactivetrading.com, you'll see that, you know, why buy a married put? You start off underwater. Well, you really don't. All I'm risking when I open this position is a bid-ask spread. But to appeal to you and to really answer your question that you're really here for, Simeon, what is the reverse? And I think this is what you mean. A covered short is what we typically call a married call, if I'm not mistaken. So what if I was bearish and I sold 100 shares of Mondelez at 44.66? And at the time, rather than buying a put, of course, to cover the short, I want to buy an in-the-money call. So let's say I bought the 42 call for a price of $5. So I short the stock and I buy the call. I am still in a bearish position, but now if the stock moves up, that's where my risk is, but it's capped at only 5.9%. Between now and January expiration, the worst case scenario that could happen, assuming I hold this position all the way to January expiration, the stock is trading above my call at $42 per share and I make no adjustments, sell no puts against it or anything like that, the most I could lose is 5.9%. This to me is a covered short. It's what we call a married call. Okay? You can do it shorter term as well, but at the same time, you're going to end up with a position where you could lose the max amount, but at least it's capped. So if Mondelez goes up to $50, totally against your bearish expiration, the most you could lose is 5.9%. Okay? All right. So this is what I think you're referring to. It could be one of two things. And I know this is hard to explain because everyone uses different terminology on these. And the terminology in this sense of the word is that to me, if you said a covered short, I'd mean that you're trying to protect a short. But there is also what's called a covered put position, and that's simply the reverse of a covered call. Again, let's say you were bearish, same as me, and you sold Mondelez at 44.66. But rather than protect the position by buying the call, you wanted to enhance your profit, and at the time, you sold an out-of-the-money 44.66. Yeah, you sold an out-of-the-money, no, you sold an out-of-the-money 44 put at the time for $1. Okay, so this is shorting the stock and shorting the put. It's the reverse of a covered call. you get the reverse profit and loss chart. When would you use this? Only if you're bearish. What is the risk? Infinite upside risk, just like a naked call. Okay, so did you hedge the short by gaining $1? Yes, but remember, unlike a stock which can go to zero, where you know that your cost basis on the covered call is 100% of what you're risking, when you're short the stock, if it moves up $1, that short put covered it, but if it goes up more than that, you still have essentially infinite risk to the upside. This is called a covered put. So when you use the term, protected short or covered short, it could be referring to the covered put, which is the reverse of a covered call. You're bearish, you're shorting the stock. And then, of course, in the married call, you're shorting stock and you're also bearish, but you've added a long call to cover the position so that you have a maximum risk if the stock goes the opposite direction and you're still in a bearish mode. This one has a capped gain. This one does not. This one you'd have to pay for the put. This one you'd collect extra premium on top of the short stock there. So you have a break even now of 45.66. Okay, so this is a covered put, the opposite of a covered call. It's an income strategy if you're bearish and you're allowed to short stock in your account. Otherwise, the married call is the one that still bearish, but you have a limited risk if the stock moves up against you, and you still have higher potential for profit if it really drops down. But we're talking about almost losing 50% of its value. All right, okay. Okay, Frank wanted to share something with us. He says, FYI, buying a 0.3 delta strangle. Okay, so what I showed on MU earlier, and thank you, Frank, I appreciate you chiming in. This is something I'm playing with for short-term profit. The percentage looks good, but the monetary return's not that great, but it's been working out because of the market conditions and the way that earnings have been. Now, this isn't going to be the same thing. I'm going to show you essentially what I did for today's expiration. I had sold 26 and 26, and I think I said my prices were 96 for the call, I believe. And it's like 89. Oops. I think it was, yeah, maybe it was 185. Maybe it was 185, and I ended up selling it for 345. It was either 180 or 185, and I sold it, the call at 345 today at the sudden gap up when the stock was at 29.35. Of course, it came back. I got lucky, and it continued to fall, so I got a good premium off of that. So it was a good return, right? I made a $1.60 profit on a $1.80 investment on this one. So that was pretty good. But what Frank's saying is that he goes 3 months out and putting on a 10 to 20% sell at the same time. So he gives you a very high rate of success. Right? So he's buying a 3 delta strangle that's 3 months out, and he puts a 10 to 20% sell at the same time. So the short strangle, 10 to 20% out of the money at the same time as he does the 0.3 delta strangle that he buys, if I'm reading that correctly. So that's what he's doing, and it gives you a very high rate of success. And Frank, if you have the time, if you could email me to support@powerop.com, I'd love to take a look at, just give me an example of 1 or 2 of the recent positions that you entered there on that, okay? All right. Okay, so Simeon says, yes, that's exactly what I meant. Okay, yeah, so covered put versus a married call, both are bearish positions. And, it's the same thing as comparing what is the pros and cons of a covered call versus a married put. And let's go back to MDLZ. So if I did a covered call on Mondelez, and I had sold, let's say, the April 17th 45 call, which, by the way, is done in this comparison. Oops, sorry. I'm sorry, let me go back one. I don't know if you guys can see this very well, but the comparison I mentioned on the blog is here's the covered call on Mondelez where we would have lowered the cost basis to 44.01. Okay, at the same time I entered the married put trade. So it sold the 45 at the time for 65 cents. Okay, and so that's a sell, isn't it, folks? There we go, fantastic. So the return is 2.2 or $99 if the stock's above 45 at April expiration. okay? But I'm still risking 44.01 if the stock collapses. So this is a covered call, short-term trade, potential for a 2.2 maximum return, which is great for a 7 or 14-day trade, but I still have open risk to the downside. Of course, we see where the stock is now. Versus the married put, where I bought that January 47 put at 540. Okay, so now my risk is 6.1%. But I still have unlimited upside. And what we compared is if you saw a 3 or 4% movement in the stock, really about a 5% movement in the stock, and the stock went up to, sorry folks, 50.06, okay. Well, 50.06 is the break even. But let's say the stock did move up 5%, we'd be at about 46.86, I think. But let's say it moved up 5% in the first 20 to 30 days. See, the married put still is a profit. If I'm at 46.86, I'm not near that break even at 50.06. But where I'm going with that, of course, in relation to Simeon, is that that comparison is the same with the covered put versus the married call. If I short the stock and buy the call, I have protection in place in case the stock moves in the opposite direction. Okay, so buy one at 4. Sorry. Okay, so I can still realize more profit to the downside. I've insured the short stock position, in this case, by buying the call. And then, of course, on the other side, if I sold a near-term put to generate income to create the covered put, well, I have a capped gain on the position, and it turns around that if the stock goes the opposite direction, sure, I've hedged that by maybe 50 cents or $1, but I still have a lot of loss. So it's not really protected if I'm wrong. Okay, that's why the married call, it allows you to take more advantage if you're right and the stock really collapses, but you've protected the upside in case it goes in the wrong direction. That would be a married call. And thank you, Simeon. Another thing I want to mention. This is not the stock to do either one on. Okay, Mondelez is not a stock to do a short put. No, not a short put, I'm sorry. A naked call, a covered put, or a married call. It's not one to do one of the short stock positions. I'm not saying it's not one to do a bearish position. I'm not saying I'm a strong bull on Mondelez, even though I've just entered a bullish position on it. What I'm saying is that any stock that pays a dividend, Mondelez, Johnson & Johnson, anything like that, you don't want to be in a covered put or a married call position where you've shorted the stock because you end up paying the dividend. So if you're planning on staying in it for an extended period of time, crossing 1 or 2 Ex-Dividend dates, or even just 1 Ex-Dividend date, when you cross the Ex-Dividend date, you have to pay the dividend, so you're going to take away from this profit. Or you're going to add to the cost basis, or detract from the premium cost basis of shorting the stock and buying the call in the married call position. So anytime you're in a short position, which is a covered put, a married call, or a short collar. And what is a short collar? We looked at collars earlier, but a short collar would be where I would short the stock, sell the put as I'm doing here in the covered put, but then I'd buy the out-of-the-money 1-month call, so I'd end up with that sort of bear call credit spread profit and loss chart where I do have a minimized risk to the upside. I do have a potential max profit there. But the married call or the short collar, make sure you're not picking a stock that pays a dividend, and if you are, make sure the ex-dividend date isn't coming up between now and expiration because you'll pay the dividend, and that might lower your profit in both scenarios because you have to give something back. You have to pay the dividend. Okay, so that's the other thing to consider when comparing the bearish strategies. Covered put, married call, and short collar. You're shorting stock. If it pays a dividend, you pay the dividend. It's going to change your profit and loss. All right. Well, ladies and gentlemen, looks like I answered all the questions that I saw that came in. If I missed a question, please just let me know. I think I got everyone's question there. So what I'll do now, if you have any last-minute questions, of course, go ahead and send those to me right now. We are, of course, at about 5:45 p.m. Eastern Time. Oh, what am I doing? Okay. Sorry about that. We're at 5:45 p.m. Eastern Time. So if I don't see any other questions come in, we are, of course, at that break there. or at our time limit, I should say. I just wanted to remind you, those that are joining me today, of course, if you haven't tested out Power Options yet, remember, go to powerop.com and you can take a 14-day free trial by putting in your first name, last name, and email address. So you don't need any credit card information. You'll have full use of the tools on the 20-minute delayed service for 14 days. And then, of course, Cindy had mentioned, well, what about the cost? Okay, we offer a few levels of service for the Power Options tools we saw today. We didn't even go really into the search tools for the 23 different strategies we support. Showed a little bit about the portfolio. We offer an end-of-day service. It gives you access to the search tools in all 23 strategies, the portfolio tools for tracking and managing your positions. Any Power Options trial member or subscriber can schedule a coaching session. It's essentially an hour-long conversation with myself or Ernie, or 30 to 40 minutes or so. We'll walk you through the tools on the site and answer any questions you have. The end-of-day service, data is only updated at the end of the day. That's $40 per month. We do offer a 20-minute delayed service as well. So anytime you run a search, refresh a page, the data you're seeing is about 15 minutes, 18 minutes, 20 minutes delayed, and that's $60 per month. We do also offer a real-time service. So every time you refresh a search or one of the profit and loss charts or your portfolio, you're getting the numbers and calculations at that very instant, and that's $120 per month. Why is it so expensive? Why is it double? Well, it used to be less, I'll be honest with you. I know that there's a lot of maybe sore thoughts on this or thoughts we don't want to get into because we like to talk about options, not politics. But just like every year since I've had company health insurance, my premiums go up every year. Related to ACA or not related to ACA, my insurance per month always goes up. But at the exchanges, they every year increase their fees for redistribution of real-time data. So every year we see a 10 to 15% increase in our fees to redistribute real-time data. So that's why, unfortunately, the price had to go up to justify the real-time cost and the real-time service, unfortunately, as well. But anyway, we do offer a real-time service if you're doing more active spread trading and things of that nature. What is this one in the middle, this historical service at $100 per month? We did do a little bit of back testing. I showed you the historical chain today. We went back a couple days on MU to see what the 26 strikes were. We offer backtesting services where you can run searches for covered calls and all 23 strategies based on your criteria, but back in time. So you can run the search against a database any year back in time. We go all the way back to April 2006, and you can see which trades would have matched your search results on a given date, and then see how those positions that match your criteria would have performed to the expiration date that you were screening for. So you can get a gauge of, hey, these are the top 10 positions and I opened all 10, what would my return be from March 2006 to April, April 2006 to May 2006 or May to June, and keep scrolling forward to help you test your strategies. But that's what the historical backtesting tools offers, everything on the delayed with access to our full historical tools, historical chain, stock quotes, and so forth. All right, so Cindy, the lowest service we have is end of day at $40 per month. Most popular is the 20-minute delayed service as well at $60 per month. We do have a real-time service. All right. Now, if you're interested in looking at some other education, I already pointed you out to a couple of webinars today on managing your broken position and managing your naked puts. But at any time, you can go to blog.powerop.com to see some of our most recent write-ups on different options related and Power Options tools related concepts and discussions we've had with customers. 90% of the webinars I host during the week, you can access those as we saw at powerop.com/webinars.asp. There's a tab on the webinars page called Requested Topics. That is where I archive all of these Friday sessions. I'll convert today's presentation. I'll hopefully have it available for you tomorrow on the webinars page under Requested Topics. And of course, you can check out our YouTube channel at any time. Just go to YouTube and search for Power Options. And you can check out our YouTube channel where a lot of archived presentations are available as well. All right. Okay. Oh, Sam just had a follow-up there. He says, okay, here. So how will the healthcare vote affect the biotech markets on Monday? CNC was up 2 to 3%. Others were negative today, GNG and PFE. I don't know, Sam. It's going to be interesting to see what happens on Monday with this discussion, and we will probably check after hours numbers and see as well. you traded MOH today and got out at 230, okay, and this, the spread got too wide. You were in the options and the spread got too wide towards the end because of volatility. Yeah, going to be interesting to see what happens Monday after what happened today with the AHCA House vote, or non-vote, I should say. So it'll be interesting to see how the market and how the healthcare replies to that. I'm assuming they're going to pull back, but flip a coin. It might have already been priced in. I don't know. We'll have to see. All right. So, ladies and gentlemen, thank you for joining me today, and thank you for your excellent questions. I do want to remind you, if you think of any questions later on, just send me an email anytime to support@powerop.com. And, of course, if you have questions about radioactive trading, you can email us anytime to support@radioactivetrading.com as well. And, of course, we are available via phone. You can call us at 302-992-7971 if you have any questions, of course, but we're available during market hours also. Okay? So, take care, everyone. Have a fantastic weekend. I'm not going to be available next week for any webinars, so we won't see you on the 31st. We'll hopefully see you again on April 7th, and as I mentioned to Joel earlier in the webinar, hopefully on April 4th, I believe it is, April 5th, we should have that finish up third part of our calendar spread series, diagonal and horizontal spread series on the management techniques, but we'll see. Okay, but that's what I'm hoping for, Joel, and I apologize you didn't have it this week, and I won't be available next week. So thank you, ladies and gentlemen, again. Have a great weekend. Happy trading. We'll see you soon. Good night.